Question 1. A property insurance adjuster is evaluating a claim for a fire that caused extensive damage to a homeowner's residence. The policyholder has requested a full replacement of all damaged items based on their initial purchase value, not the current market value. Under typical property insurance policies, what valuation method is most likely to be applied for settlement? A. Salvage value. B. Replacement cost value (SCV). C. Actual cash value (SCV). D. Agreed value. Answer: C. Actual cash value (SCV). Explanation: in property insurance, unless specified otherwise, settlements are typically based on actual cash value (SCV). SCV accounts for depreciation by calculating the item's replacement cost minus any depreciation due to wear, age, or obsolescence. Although replacement cost value (RCV) policies exist, they require specific endorsements and often come with higher premiums. Salvage value refers to the value after recovery or repair, and agreed value is a predetermined value for high-value items, which is generally not applied to standard personal property claims. Kentucky's property insurance regulations require adjusters to handle claims following policy stipulations and applicable valuation methods to avoid unfair claims practices. Question 2. Scenario-based. Mr. Daniels owns a small business and holds a commercial general liability (CGL) policy. During a storm, a large tree branch fell on the business property, causing significant damage to a neighboring building. The building owner has filed a claim against Mr. Daniels for property damage. What should Mr. Daniels adjuster do to evaluate this claim under the CGL policy? A. Investigate whether Mr. Daniels was negligent in maintaining his property. B. Verify that Mr. Daniels has sufficient personal liability coverage for the claim. C. Deny the claim as storm damage is an act of God and thus not covered under the CGL. D. Settle the claim directly without further investigation, assuming responsibility. Answer: A. Investigate whether Mr. Daniels was negligent in maintaining his property. Explanation: under CGL policy, liability is typically covered if the insured is found to have been negligent or legally liable for the damages. The adjuster should investigate the claim to determine if Mr. Daniels' negligence contributed to the incident, e.g., failing to remove hazardous tree limbs, simply because the damage resulted from a natural event. It does not automatically exempt liability. The insured's actions in preventing foreseeable risks matter. Kentucky's claims regulations emphasize that thorough investigation is crucial in cases of potential negligence. Options B and C are incorrect, as the CGL is business-related, not personal liability, and an act of God defenses require specific exclusions, which may not apply if negligence is involved. Selling without investigation could breach fair claims practices. Question 3. A Kentucky-based auto insurance adjuster is handling a claim where the insured driver was involved in an accident with an uninsured motorist. Under Kentucky's insurance requirements, what coverage type should the adjuster review to determine if the claim qualifies for coverage? A. Collision coverage. B. Comprehensive coverage. C. Uninsured motorist coverage. D. Liability coverage. Answer: C. Uninsured motorist coverage. Explanation: uninsured motorist coverage is designed to cover damages when the insured driver is involved in an accident with an uninsured or hit-and-run driver. Kentucky requires auto insurers to offer coverage as part of auto policies, which helps protect policyholders when the other party lacks insurance. Collision and comprehensive coverages pertain to physical damages to the insured's own vehicle due to accidents or other perils, not necessarily involving other drivers' insurance status. Liability coverage, on the other hand, covers damages the insured causes to third parties, not claims involving uninsured motorists. Kentucky statutes mandate that adjusters ensure claims are handled according to coverage terms and applicable state laws on coverage. Question 4. An insured homeowner in Kentucky claims water damage to their basement following a recent heavy rainstorm. Their standard homeowner's insurance policy includes an endorsement for water backup. Which of the following situations would most likely qualify for coverage under this endorsement? A. Surface water flooding from the storm seeping into the basement. B. A broken window caused by storm debris allowing rainwater into the basement. C. Sewer backup resulting in water overflowing into the basement. D. Rising groundwater entering the basement due to excessive rain. Answer: C. Sewer backup resulting in water overflowing into the basement. Explanation: standard homeowners policies generally do not cover flood or surface water. Instead, coverage for these perils typically requires a separate flood insurance policy. However, water backup endorsement specifically covers water damage caused by sewer or drain backups. Since Kentucky regulations align with most state insurance norms, adjusters must be cautious to only apply coverage for backup events and not for surface water, which is excluded under standard policies. Options A, B, and D would not be covered under a standard water backup endorsement. Question 5, scenario-based. MS. Green, an adjuster in Kentucky, is handling a claim where a business owner experienced a total loss due to fire. The policy includes a coinsurance clause requiring the property to be insured to at least 80% of its value. The business was insured for $500,000, but the replacement cost of the property was estimated at $700,000. Based on these figures, what would MS. Green do in processing the claim? A. Deny the claim due to underinsurance. B. Calculate the settlement using an 80% coinsurance formula. C. Pay the full policy limit of $500,000 regardless of replacement cost. D. Reduce the claim payout by 20%. Answer. B. Calculate the settlement using an 80% coinsurance formula. Explanation. Coinsurance clauses require the policyholder to insure their property to a minimum specified percentage, in this case 80% of its value. If this requirement is not met, the insurer will proportionally reduce the claim payout based on the amount of underinsurance. Here, the insured amount is $500,000, but 80% of $700,000 is $560,000, meaning the insured amount falls short. Kentucky insurance regulations expect adjusters to carefully apply coinsurance clauses, as failure to insure to the required level affects the payout. Thus, MS. Green should use the coinsurance formula to calculate the reduced payout. Question 6. In Kentucky, an adjuster is processing a claim for an insured individual who experienced theft of their high-value jewelry. The homeowner's policy has a standard personal property limit of $50,000 with a $5,000 special limit for jewelry theft. The adjuster's investigation reveals the stolen jewelry is valued at $10,000. How should the adjuster proceed with the claim? A. Pay the full $10,000 claim. B. Pay the $5,000 special limit for jewelry theft. C. Deny the claim as jewelry theft is excluded. D. Reduce the payment based on depreciation. Answer. B. Pay the $5,000 special limit for jewelry theft. Explanation. Homeowners' policies often include sublimits on high-value categories like jewelry, particularly for theft losses. The policy's special limit for jewelry theft of $5,000 means the insurer's liability is capped at that amount regardless of the item's actual value. Kentucky insurance policies adhere to these sublimits unless the insured has purchased additional scheduled coverage for their high-value items. Options A and D are incorrect as the policy limit controls the payout. C is incorrect as the item is covered but capped by the special limit. Question 7. The Kentucky commercial adjuster is assessing a business interruption by claim for a factory that was shut down due to a covered fire loss. Which of the following expenses would generally be covered under business interruption insurance? A. Lost revenue during the repair period. B. Expenses to replace damaged equipment. C. Costs for new security upgrades. D. Damages related to a third-party lawsuit. Answer A. Lost revenue during the repair period. Explanation. Business interruption insurance is intended to cover the loss of income a business experiences due to a covered peril that causes a suspension of operations. This coverage usually includes lost revenue and fixed expenses like rent or employee salaries during the period of restoration. Expenses for physical repairs or upgrades, such as options B and C, are typically addressed under property coverage rather than BI. Third-party lawsuits, D, are unrelated to BI coverage, as BI focuses on compensating lost income, not liabilities to others. Question 8. Which of the following is typically not a duty of an insurance adjuster under Kentucky's Fair Claims Practices? A. Promptly acknowledging and responding to communications regarding a claim. B. Investigating the facts of the claim thoroughly. C. Offering legal advice to policyholders on claim-related issues. D. Making a fair and equitable settlement offer when liability is clear. Answer. C. Offering legal advice to policyholders on claim-related issues. Explanation. Adjusters are responsible for managing claims in accordance with Kentucky's Fair Claims Practices, which require prompt communication, thorough investigation, and fair settlement offers. However, adjusters are not permitted to provide legal advice, as that is outside the scope of their role and could lead to a conflict of interest or ethical issues. Legal advice should come from licensed attorneys, not insurance adjusters. Kentucky's Fair Claims statutes ensure them. Adjusters focus on fair handling without stepping into roles outside their expertise, such as providing legal counsel. Question 9. A claimant submits a Kentucky auto insurance claim stating their vehicle was hit by a driver who fled the scene. The claimant's policy includes uninsured motorist coverage but does not have collision coverage. How should the adjuster proceed? A. Deny the claim, as only collision coverage applies. B. Process the claim under coverages. A hit-and-run incident. C. Deny the claim, as coverage does not apply to hit-and-run accidents. D. Offer partial payment for damages based on depreciation. Answer: B. Process the claim under coverage as a hit-and-run incident. Explanation: uninsured motorist coverage is designed to cover situations where the at-fault driver is uninsured or cannot be identified, such as in a hit-and-run. In Kentucky, hit-and-run incidents typically fall under coverage when collision coverage is absent. Denial of the claim options A and C would be incorrect, as covers these circumstances. Option D is irrelevant since applies directly to the incident and does not involve depreciation on physical repairs. Question 10. A homeowner in Kentucky experiences a roof leak that was caused by gradual wear and tear rather than a sudden event. The homeowner files a claim for water damage. How should an adjuster address this under standard homeowners insurance policies? A. Approve the claim as long as the damage exceeds the deductible. B. Deny the claim as wear and tear are typically excluded. C. Partially pay the claim based on the age of the roof. D. Refer the claim to an independent contractor for valuation. Answer: B. Deny the claim as wear and tear are typically excluded. Explanation: homeowners insurance policies generally cover sudden accidental damage rather than damage from long-term wear and tear, which is considered a maintenance issue. Kentucky policies align with this principle, excluding coverage for routine maintenance or gradual deterioration. Thus, option B correctly applies the exclusion for wear and tear. Options A and C would be incorrect, as they ignore the exclusion, referring to an independent contractor. D may be unnecessary, as the policy terms already address this type of damage. Question 11. A Kentucky homeowners insurance policy includes a windstorm deductible, which applies separately from the standard deductible. A severe windstorm causes $15,000 in damage to the property, and the windstorm deductible is 2% of the dwelling coverage limit, which is $300,000. How much will the insured receive after the deductible is applied? A. $9,000. B. $15,000. C. $6,000. D. $12,000. Answer: D. $12,000. Explanation: a windstorm deductible is usually a percentage of the dwelling coverage limit. Here, 2% of the $300,000 coverage limit equals a deductible of $6,000. Therefore, the amount the insured will receive after applying the $6,000 deductible to the $15,000 in damages is $9,000. Kentucky policies often specify separate deductibles for windstorm damage, requiring adjusters to calculate the deductible as a percentage rather than a fixed dollar amount. Question 12. In Kentucky, which of the following types of claims would most likely be covered under a commercial general liability CGL policy? A. Data breach that exposes customer information. B. A slip and fall injury at the insured's business premises. C. Loss of income due to temporary business closure. D. Product malfunction causing damage to the insured's own property. Answer: B. A slip and fall injury at the insured's business premises. Explanation: CGL policies cover bodily injury and property damage claims arising from the insured's business operations. A slip and fall injury on the premises, option B, is covered as it falls under bodily injury liability. Data breaches, they typically require cyber liability insurance. Loss of income, C, falls under business interruption, and product malfunction causing damage to the insured's own property, D, would not be covered by CGL as it generally excludes damages to the insured's property. Question 13. Which of the following actions is NOT compliant with Kentucky's insurance regulations for adjusters? A. Disclosing confidential claim information to a third party without consent. B. Settling a claim within the policy limits when liability is clear. C. Investigating the claim thoroughly before making a settlement offer. D. Informing the claimant about the procedures for claim submission. Answer: A. Disclosing confidential claim information to a third party without consent. Explanation: Kentucky's insurance regulations mandate that adjusters protect the confidentiality of claim information. Unauthorized disclosure of such information is a violation of ethical and regulatory standards. Options B, C, and D are compliant with fair claims practices, whereas option A would breach confidentiality and could result in penalties. Question 14. An insured has a HO3 policy with replacement cost coverage, SEC, on their dwelling, but actual cash value, SCV, on their personal property. After a fire, their $5,000 sofa is destroyed. Depreciation on the sofa is calculated at $2,000. What will the adjuster pay for the sofa under these policy terms? A. $5,000. B. $3,000. C. $2,000. D. $0. Answer B. $3,000. Explanation. With SCV coverage, payment is based on the item's depreciated value calculated as replacement cost minus depreciation. Here, the sofa's CV is $5,000, $2,000, resulting in a $3,000 payout. Since our CC only applies to the dwelling in this scenario, personal property like the sofa is not replaced at full value, limiting the payout to its CV. Question 15. Under Kentucky insurance regulations, which of the following would be considered an unfair claims practice? A. Communicating regularly with the claimant about the status of their claim. B. Promptly investigating a claim to avoid unnecessary delays. C. Offering a settlement that is unreasonably low. D. Denying a claim with detailed written explanations. Answer C. Offering a settlement that is unreasonably low. Explanation. Kentucky's insurance laws prohibit unfair claims practices, which include offering unreasonably low settlements to pressure claimants into accepting less than what is fair. Options A, B, and D align with fair claims practices by promoting transparency, communication, and proper claim management, while option C constitutes a prohibited practice. Question 16. A Kentucky homeowner submits a claim for a cracked foundation caused by natural settling over time. Which of the following would be the most appropriate response from an adjuster? A. Approve the claim in full. B. Deny the claim as it is likely excluded under wear and tear provisions. C. Offer partial payment based on depreciation. D. Approve the claim under a separate earthquake endorsement. Answer B. Deny the claim as it is likely excluded under wear and tear provisions. Explanation. Damage due to natural settling or wear and tear is generally excluded in standard homeowners policies. Kentucky policies typically cover sudden and accidental damage, but exclude gradual issues such as settling. Therefore, option B is the correct response, as settling is usually excluded and would not be covered by a standard or earthquake endorsement. Question 17. An insured's Kentucky homeowner policy includes an ordinance or law endorsement. Which type of expense would this endorsement most likely cover? A. Cosmetic repairs. B. Upgrades to comply with local building codes after a covered loss. C. Flood damage. D. Routine maintenance expenses. Answer B. Upgrades to comply with local building codes after a covered loss. Explanation. An ordinance or law endorsement covers the increased costs of construction needed to comply with new or updated building codes after a covered loss. This endorsement does not apply to routine maintenance or cosmetic upgrades and excludes flood damage. In Kentucky, this endorsement helps insureds meet building code requirements after a property loss, ensuring that repairs or rebuilds are up to code. Question 18. A Kentucky adjuster receives a claim for roof damage caused by hail. The roof is 15 years old and the policy includes a roof surfacing payment schedule endorsement. Which of the following statements is true regarding this endorsement? A. The roof will be replaced at full replacement cost. B. The adjuster will apply a depreciation factor based on the roof's age. C. The roof damage will not be covered due to age. D. The endorsement applies only to commercial policies. Answer B. The adjuster will apply a depreciation factor based on the roof's age. Explanation. The roof surfacing payment schedule endorsement applies a depreciation factor to the roof based on its age, reducing the amount paid for roof replacement. In this case, the adjuster would calculate the payment based on the roof's depreciated value, reflecting wear and tear over its 15-year life. This endorsement is often found in homeowner policies to limit the insurer's liability for older roofs rather than covering replacement at full value. Question 19. A Kentucky homeowner with a standard policy has a sudden and accidental pipe burst leading to significant water damage. The water damage is covered, but would the cost to replace the damaged pipe itself also be covered? A. Yes, both the water damage and pipe replacement are covered. B. No, only the resulting water damage is covered. C. Only part of the pipe replacement cost is covered. D. No, neither the pipe replacement nor water damage is covered. Answer B. No, only the resulting water damage is covered. Explanation. While water damage from a sudden pipe burst is typically covered under standard homeowners policies, the cost to repair or replace the pipe itself is often excluded, as it is considered a maintenance issue. In Kentucky, as in many other states, homeowner policies generally cover consequential damage from the burst, but not the repair or replacement of the defective component causing the damage. Question 20. A Kentucky homeowner has a dwelling policy that covers fire, theft, and vandalism. During a burglary, the homeowner's dog bites the intruder. The homeowner submits a claim for the dog bite incident under their policy. How should the adjuster proceed? A. Deny the claim as personal liability for dog bites is not covered under a dwelling policy. B. Approve the claim under vandalism coverage. C. Approve the claim under personal liability coverage. D. Pay for damages based on the dog bite endorsement. Answer A. Deny the claim as personal liability for dog bites is not covered under a dwelling policy. Explanation. Dwelling policies primarily cover property damage from specific perils and generally do not include personal liability coverage, which would be required to cover a dog bite incident. Kentucky dwelling policies often exclude such liability coverages unless specifically endorsed, meaning dog bites would not be covered. Question 21. An insured's Kentucky homeowner policy includes both replacement cost coverage or EC for the dwelling and personal property replacement (PSC) endorsement. During a covered loss, a 5-year-old television originally purchased for $2,000 is destroyed. If the current cost to replace the television is $1,800, how much will the insured receive? A. $1,800. B. $2,000. C. The depreciated value of the television. D. No payment since the item is over 5 years old. Answer A. $1,800. Explanation. With a personal property replacement cost (POC) endorsement, the insured receives the replacement cost of the item, not the depreciated value. Since the television's replacement cost is $1,800, the insured will receive this amount. Kentucky insurers offer PPRC endorsements to allow policyholders to replace personal property items with comparable new items instead of paying the depreciated value. Question 22. A Kentucky commercial property policyholder files a claim for damages caused by a power surge that resulted in significant damage to their equipment. The policy includes a utility services endorsement. What portion of this loss is most likely covered? A. The entire equipment repair or replacement cost. B. Loss of business income only. C. Damage to inventory but not equipment. D. None, as utility surges are typically excluded. Answer B. Loss of business income only. Explanation. The utility services endorsement generally covers loss of business income when power supply disruptions impact the insured's operations. However, it may not cover direct damage to equipment unless explicitly stated. Kentucky policies with this endorsement help businesses recover lost income but often exclude physical damage unless specified. Question 23. A Kentucky homeowner's insurance policy with an earthquake endorsement includes a deductible that is 5% of the dwelling coverage limit. If the dwelling coverage limit is $400,000 and an earthquake causes $50,000 in damage, how much will the insurance company pay after the deductible? A. $50,000. B. $30,000. C. $20,000. D. $0. Answer C. $20,000. Explanation. The earthquake deductible is calculated as 5% of the dwelling limit, which is $400,000. 5% of $400,000 is $20,000, so the deductible is $20,000. After applying the deductible to the $50,000 damage, the insurance will pay $30,000, $50,000. $20,000. Kentucky policies often use percentage-based deductibles for earthquake coverage, which can result in higher out-of-pocket costs. Question 24. Under Kentucky law, which of the following would be considered an example of an unfair trade practice by an adjuster? A. Consistently following up on outstanding claims. B. Offering fair settlement amounts based on policy coverage. C. Misrepresenting policy provisions to avoid a claim payment. D. Promptly notifying the insured of any delays in processing. Answer C. Misrepresenting policy provisions to avoid a claim payment. Explanation. Misrepresenting policy provisions to influence a claims decision is an unfair trade practice and violates Kentucky law. Adjusters must act ethically and in good faith. Options A, B, and D reflect proper conduct, whereas option C constitutes a prohibited practice that can lead to disciplinary action. Question 25. In Kentucky, which type of loss is likely to be covered under a standard commercial general liability (CGL) policy? A. Employee injury during work. B. A customer injury on business premises. C. Pollution-related damage. D. Damage to the insured's own property. Answer B. A customer injury on business premises. Explanation. CGL policies cover third-party bodily injury and property damage arising from business operations. A customer injury on the premises would fall under bodily injury liability, making it covered under CGL. Employee injuries are covered by workers' compensation. Pollution damage C typically requires an environmental liability policy, and damage to the insured's own property D is generally excluded from CGL coverage. Question 26. The Kentucky Auto Insurance policy includes uninsured motorist coverage. Which of the following scenarios would most likely be covered by the policy? A. The insured's vehicle is struck by a hit-and-run driver. B. The insured's vehicle is damaged in a flood. C. The insured is injured while driving without insurance. D. The insured's vehicle is stolen. Answer A. The insured's vehicle is struck by a hit-and-run driver. Explanation. Uninsured motorist coverage compensates the insured if they are hit by a driver with no insurance or in a hit-and-run accident. Kentucky policies often include coverage to protect policyholders in such cases. Flood damage. B. Driving without insurance. C. And vehicle theft. D. Are not covered by policies. Question 27. Which of the following perils is typically excluded in a Kentucky HO3 policy but could be covered by an endorsement? A. Fire. B. Theft. C. Flood. D. Windstorm. Answer C. Flood. Explanation. Standard homeowners policies, including HO3, generally exclude flood damage, which can be covered through a separate flood insurance policy or endorsement. Fire, theft, and windstorm are typically covered perils under a HO3 policy. Kentucky homeowners seeking flood protection must purchase additional coverage due to standard exclusions. Question 20. In Kentucky, an insured with a personal auto policy, PAP, has liability limits of $25, $50, $25. If the insured causes an accident resulting in $60,000 in bodily injury to one person, how much will the insurance policy cover? A. $60,000. B. $50,000. C. $25,000. D. $30,000. Answer C. $25,000. Explanation. The liability limit for bodily injury per person in this policy is $25,000. Therefore, even though the damages are $60,000, the policy will only cover $25,000 for one person's bodily injury. Kentucky's minimum limits of $25, $50, $25 mean that the insurer will pay a maximum of $25,000 per injured person, up to $50,000 per accident for bodily injuries. Question 29. An insured with a Kentucky homeowner policy experiences roof damage from a tornado. If the policy includes a roof payment schedule endorsement, how will the claim be processed? A. Replacement cost with no depreciation. B. Replacement cost minus depreciation based on roof age. C. Full coverage for the roof replacement. D. No coverage due to wear and tear. Answer B. Replacement cost minus depreciation based on roof age. Explanation. A roof payment schedule endorsement applies depreciation based on the roof's age, which reduces the payout amount. This endorsement is often used in Kentucky to manage insurer costs on older roofs. As a result, the adjuster will calculate payment based on the roof's depreciated value, not full replacement cost. Question 30. A Kentucky adjuster is handling a claim for water damage caused by a leaking roof after a heavy rainstorm. The insured's policy excludes wear and tear. How should the adjuster handle the claim? A. Approve all repair costs for both the roof and water damage. B. Approve only the repair costs for the water damage but deny roof repair costs. C. Deny all repair costs due to the wear and tear exclusion. D. Deny the claim in full as rainwater damage is not covered. Answer B. Approve only the repair costs for the water damage but deny roof repair costs. Explanation. Standard homeowner policies generally cover water damage from rain if it enters due to sudden and accidental damage, but they exclude damage resulting from wear and tear. In this case, the adjuster would cover the resulting water damage but deny payment for roof repairs, which fall under wear and tear exclusions in Kentucky policies.